Sidebar, Bracewell's podcast devoted to government enforcement investigations, corporate compliance, and white-collar criminal defense. I'm Matthew Nielsen.
And I'm Seth Ducharme.
And we are your host and both partners at Bracewell LLP, where we represent companies, boards of directors, and individuals in all manners of litigation, investigation, and enforcement actions. Welcome to today's episode of Sidebar. Today, we are going to be talking about issues relating to recent bank failures that have been in the news, understand maybe what's happened, what is involved in when a bank fails, and talk a little bit about what the future may hold. With me today are two of my great colleagues. We have Will Anderson. Will is the co-chair of Bracewell's corporate and securities practice and chair of the firm's financial institution group. He focuses on capital markets transactions, mergers and acquisitions, and SEC compliance and disclosure matters. And he has a particular specialty when it comes to transactions involving banks and specifically community banks. Other guest today is Bob Clarke. Bob Clarke is a retired partner at Bracewell, and he's the founder of the firm's global financial services practice and continues to serve as counsel to the firm. Bob has an incredible background, including the fact that he was the comptroller of the currency, appointed first by President Ronald Reagan, and then was reappointed the position by President George Herbert Walker Bush. He served in that role from December of 1985 through February of 1992, supervising approximately 5,000 nationally chartered commercial banks. And I think we're going to talk a little bit, but that was a particular interesting time given the substantial number of bank failures that Bob had to help oversee. Will and Bob, thanks for joining us today.
Glad to be here.
Good to be here. Thank you.
So I guess, Bob, when I started the introduction, I talked about how you were the US Comptroller of the currency. And so what is that role? What did you do in that role?
The Office of the Controller of the Currency was established in 1863. It's one of the oldest, if not the oldest, federal agencies that there is. And the original purpose of the agency was to supervise all the nationally chartered banks, which were authorized under the National Bank Act in 1863, but also to all those national banks that were chartered, they were able to issue their own currency, and they were required to back all that currency with federal securities, U.S. Treasury securities and other types of securities. And one of the jobs of the Comptroller's office was to make sure that all the national banks actually did, in fact, have securities on deposit to back their currency. So at that time, the Comptroller really did have something to do with the currency. Today, the Office of the Controller of the Currency is strictly the federal agency that charters all of the national banks, supervises the national banks, and unfortunately, when one of them becomes insolvent, has to close them.
So we're going to talk a little bit more about some of the banks that have been in the recent news, and specifically Silicon Valley and Signature Bank. But I do want to talk about your involvement in the banking crisis that happened in the late 80s, early 90s. And so I'm sure a lot of our listeners know what I'm talking about, but some may not. So talk a little bit about what happened, what was the crisis, and then tell us a little bit about what was your involvement and what was going on from the standpoint of the regulators during that time and what your office in particular had to do.
Well, as you said, I started at the OCC in December of 1985. And prior to that time, the First National Bank of Chicago had problems and had been closed by my predecessor. And there were a number of community banks that were beginning to struggle because during this time, their energy prices had dropped precipitously, and many of the community banks that were in the Southwest were adversely affected by that. And so they had asset quality problems, pretty significant asset quality problems. And that led to a number of them gradually becoming insolvent. They weren't just community banks. I remember a group of very stern-faced examiners coming into my office soon after I got there to tell me that they were worried about Bank of America. That was not because of energy loans. That was because of shipping loans. They had a very large shipping portfolio, and a lot of the shipping companies were having financial trouble. So there was a whole variety of different economic factors that were bearing on the banks and causing them to have asset quality problems.
And so I think during this time, we were talking before we got on the podcast, is that there's probably more banks that were shut down during this time than any point in the history of the United States. I mean, there was probably a lot as a result of the Great Depression, but I don't know if there was as many banks.
Well, I think there probably were more during the Great Depression, but there were thousands during the late 80s and early 90s that we had to close. We were typically closing 4 or 5 a week. And it was really pretty amazing. And, some of them were very large institutions. They weren't all community banks. There were only there was only one of the large banks in Texas that survived. 2 of them were able to get themselves sold before they failed, thank goodness. But Frost Bank in San Antonio was the only large Texas bank that survived. All the others had to be closed over about a 3-year period. It was a particularly tough time for me because I had been a practitioner in Houston and had represented a number of banks all over Texas. And I knew all these bankers. And it's no fun to have to call chairman of the board and the president of First City Bank, for example, in Houston and tell them, I'm sorry, but we're having to close your bank tonight. It didn't come as a great surprise to those bankers because the typical bank that gets in trouble because of asset quality gets in trouble gradually. And so we usually had a window of opportunity to get the problems in the bank fixed. And if we couldn't get the problems fixed, then we had an opportunity to put the bank out for bid so that when it was failed, we had other banks that were interested in acquiring the bank. And as we'll talk about a little bit later in connection with the 2 that recently failed this year, the normal way of dealing with these failures was to find a buyer for the bank who would take all of the deposits and then part of the assets, and the FDIC would make up the difference.
And when you say poor asset quality, I mean, if I recall that during the time, and we're talking about late 80s, 90s, we're kind of talking about poorly collateralized loans, right?
Well, they were not necessarily poorly collateralized when they were made, but the collateral deteriorated in value. Just as the collateral with Silicon Valley Bank and Signature Bank, their assets were not so much collateral as they were government securities, and they deteriorated in value. So anything that adversely affects the capital of the bank, which causes the capital to get terribly depleted or even eliminated, creates a real solvency problem for any bank. And that's what we saw so much during the 80s and 90s. These banks were just becoming insolvent. Part of the problem was that the banks were required to mark their assets to market. And we kept saying that if we just let these banks go a little bit longer, they can probably work their way out of the problem. But for political reasons and other reasons, we just didn't have the opportunity to do that. And so a lot of the banks had to be closed and the ownership of the banks transferred to somebody else.
So, Will and Bob, I'll throw this to both of you. I mean, Bob, you've mentioned a number. You talked about nationally chartered banks. We've mentioned community banks. And I think those of us who aren't in the financial industry, we hear these terms and we hear banks use these terms in advertisements. But what does all that mean? I mean, we'll kind of go through a little bit about what are the different types of banks and why does that matter?
The 2 principal types of banks are national banks, and those are chartered by the Office of the Controller of the Currency. And the Office of the Controller is the principal federal regulator for those banks. The other large category of banks are the state-chartered banks that are chartered by the banking commissioners in each of the individual states. And they are supervised and regulated by their chartering authority, the state banking department. And then depending on whether they are members of the Federal Reserve System, in which case they are supervised federally by the Federal Reserve System, or if they are not members of the Fed, then they are supervised federally by the FDIC. Then in addition, you have savings banks and savings and loan associations. At the time I was controller, the savings and loans and the savings banks were all regulated by the Federal Home Loan Bank system. And so there was I had no responsibility for those and really didn't get involved with those. But there were a number of failures, as people in the real estate business would know, because savings associations were required to maintain a certain number of real estate-based loans. And in the late 80s, real estate prices tanked. And so a lot of those loans that were collateral deteriorated in value, and they led to the savings and loans and savings banks failing. Savings banks were chartered federally by the Home Loan Bank System, and the state-chartered savings and loan associations were chartered by the states, just like the banks, but they were regulated differently. And to some extent, they had different accounting rules that applied to them, which was one of the things that led to their failures.
I would just add that I think it's interesting that there's really 50 plus regulators of banks, right? There's 50 state banking departments that charter banks. And then there's the OCC that charters national banks. And then the Federal Reserve and the FDIC don't charter banks, but they do have supervisory authority at the federal level, as Bob says, over state banks. And of course, every bank is a member. It has FDIC insurance, right? So they're the FDIC, although it might not be a primary regulator, at the federal level of some banks, it does have some backup examination and regulatory authority over state banks, even if it's not the principal federal regulator. And of course, Bob, the FDIC, Bob was a member of the board of the FDIC when he served as the comptroller, as it's a 5-member board. And so he has some insight into the FDIC as well, of course.
Well, and if that number of regulators was not enough, most of the banks are owned by holding companies. Any corporation that is a bank holding company is regulated by the Federal Reserve System. So there are plenty of regulators to go around, as Bill points out.
That's right. And then, of course, if you're a publicly traded company, you have the SEC involved, of course, not from the banking side, but, from a disclosure standpoint as well. So, yeah, a lot of people roaming around. And we'll talk a little bit at the end about, kind of curious then how does a bank go about failing at that point if you have so many people presumptively looking at them. But one question I had.
Well, while you're talking about the different kinds of banks, there are also, as people would know, there are also credit unions, which are chartered by the states and by the federal government, and they're regulated by the National Credit Union Association, and they are definitely subject to different accounting rules, and they pay no income tax, which drives the commercial banks crazy.
Oh, really? Okay.
And have been trying to get that fixed. Problem is that every staff member of every member of Congress, and even most of the members of Congress themselves, are all members and customers of credit unions. So the likelihood of getting that changed is just about zero.
Yeah.
And then, of course, people refer to community banks, and they refer to regional banks, and they refer to money center banks. And, money center banks are the great big banks like Bank of America and Wells Fargo, Citibank, Chase, those banks. And they're regulated. They have a set of regulatory standards that are more complex than for community banks. Community banks, I usually think of as banks that are $5 billion or less in asset size. $5 billion sounds like a lot of money, but there are a lot of community banks that are that large. And then in the middle, you have the regional banks who are regulated more stringently than the community banks, but less stringently than the money center banks.
I think it would be interesting, Bob, if you could maybe explain why do we have community banks and what's the role of those banks? Why do we need them versus, why don't we just have Wells Fargo and Chase and B of A and a few other large money center banks?
Well, that's a very good question. And I think that, Canada is an example of a country that I believe there's 6 banks in Canada. And, a bank, we could have that model and they would just have branches in all the small towns around the country. But we've had a history in this country of having community banks separately chartered in these smaller communities. And, they're owned mostly by people who live in those communities. People who are in those communities are on the boards of the banks. They know the population. They know the businesses. They have historically been the primary providers of credit in those smaller communities. When I started, I believe there were 13,000 commercial banks in the United States, counting all of the commercial banks, state and federally chartered commercial banks. There are now far fewer than those because of banks that were closed, banks that merged together. Community banks, because they're small, are great for the communities, and they provide a service, and they know the people, and they work with their customers, which a branch of a money center bank can't do as effectively. And so they provide a real benefit to the local communities in which they exist. But they also, because of their size, are limited in what they can do. And as technology has become much more important for banking, the money center banks have been able to develop all these computer-based services, which are very popular with a lot of their customers. And the community banks have a hard time doing that because it's very expensive to do that. And so a lot of them have just kind of thrown up their hands and said, we've got to get ourselves acquired by somebody because we just can't afford to keep up with the competition. And that's unfortunate because I think community banks are really important, but it's just the real world. They have to have the financial strength to compete, and many of them don't.
And I mean, have we seen a consolidation in the banking industry of late? I know you've been busy with some transactions as well.
Yeah, over a period of many years, community banks, there's been a great deal of consolidation of community banks, and Bob's exactly right. There's a number of drivers of that. It can be the technology issue, but it can also be management succession and liquidity for owners of the banks, and just the ability to better serve customers and whatnot. But there's been a great deal, thousands of banks over the years have consolidated, and they're not all being consolidated by the big money center banks, but it's the community banks come together and create a larger bank or regional bank, and there's benefit to that. But I agree with Bob. The community banks serve a very important function, in the communities in which they're located, and particularly with small and mid-sized business owners and access to loans and kind of getting attention from bankers that were they to go to larger banks might not get the same level of attention or access to the capital that they need to grow their businesses.
Yeah, it does seem, and I've seen comments even recently from Jamie Dimon, who's CEO of JP Morgan, talking about how important that community and regional banks are to driving the American economy, right? Because most businesses are small businesses, as that's defined. And like you said, a lot of folks that are starting a business or looking to, for additional capital. Having those personal banking relationships that you certainly can have at a big bank, but that you normally think of when you think more regional, community, smaller banks, kind of really fundamental to driving the economy here. Thank you for joining us on our first part of our two-part episode on the banking failure of Silicon Valley Bank and Signature Bank, and an overview of the banking industry from a regulator. Please stay tuned for part 2 of this episode, which will be coming out soon.